he's playing it as far as Trump and the tariffs, the way Navarro is talking, and the way the markets are acting, I could see us hitting a breaker tomorrow if nothing changes overnight because of the whole EU taking a stand on things ahead of futures. Now, the question is, will it crash that far before, like, will it be futures mostly? And will we see it in a couple of hours? That's another thing I'm wondering, because they're already talking about desks.
Pulling out. So I pulled up futures options, which are currently trading.
Oh yeah, you're right. Mm-hmm.
And so this is very helpful. There is a 95% chance that the price will not go below 4,700 and won't be above 5,500. That's not real helpful, options traders. So it probably won't go up or down by 700 immediately.
Right. So we're talking about, well, it also depends on what kind of emotional response we get out of the market when the futures open, not just the options, but then when the actual futures open, do we see like other moves happen? And futures can be very strange over weekends. They can. If we had a couple of times,
This is actually, I think, the widest I have ever seen the
yeah,
S&P 500 volatility spread, because it's 4,500 to 5,500 is the big bracket, and
yeah, it
that's
made.
at 70%.
No, that's because you're talking about a bet on a bet on a bet. So
That's all markets are.
right, you're how far removed are you from reality while you're placing paper down?
As
So
someone who lives in Las Vegas, I can tell you people can get really far from reality.
yeah. Yeah. Oh, the Vegas markets. The betting markets. Now we're getting that online, so that's great. Um,
Getting there.
we've been
I
there for
feel
a
like
couple of years, I
online
know.
is probably more than in person these days.
Oh yeah.
Who has
Um,
Polymarket open for
How
tomorrow? What are they
so
saying?
Macau totally destroys online
That'd be
because
the
it's a way
well,
to
you're it's
launder
fair.
money if you're a Chinese or North Korean official.
There was a question somebody had in chat. I'm trying to dig it up. Oh, um, since we've already kind of gone, are we screwed? We don't know yet, but the market doesn't know either. Nobody knows. I will say that I have doomed like this on a weekend, and the open was like negative 107 and went up that day. But
So
this
I'll
is a
tell you
weird time.
mine. So my big financial transaction over the weekend was somewhere that sells ammunition was offering 0% financing. So I just maxed that out, and then I'll just sell it if nothing happens.
Yeah. So it was the sage's question, by the way. This what are we talking about when we see the I mean, like the two questions the sage had kind of feed into each other to me. If the tariffs stay and we end up with a lot of unemployment, and then that shakes a lot of people out of, like, I'm using kind of disconnected language here because it is kind of a terrible thing, but if people end up losing their houses because of all of the market turmoil, that's going to affect real estate. Now, does anyone want to go in and institutionally scoop that up, or do we have buyers that are ready to buy into that, especially with Trump trying to get rates cut? That there's a lot of things that could happen there, and commercial real estate is already weird, or at least,
And I'll move
yeah,
to
good.
Zach's point. No, you live in the NFT.
I don't think I could fit.
So real estate's gonna be an interesting one though, because it
Oh,
is
the
a
house is the
slightly
NFT.
it is a slightly more
Well,
stable asset class.
so
And
I'll
that's it.
on a institutional level, real estate is essentially an interest rate trade. It's not. It's considered one of the riskier sort of interest rate swap investments. Um, you don't. The problem that you run into is the circumstances where real estate prices are attractive as an institutional investor are not circumstances where you want to be an investor in real estate. If everyone loses their jobs or things like that, that means they're also doing things like not paying rent. And if you are, paying out an 8% note to pick up all this real estate, you really can't afford to let people not pay rent. So what tends to happen is on the risk side of things, companies have to reduce their exposure to that in volatility, or markets are going down, or people are trying to sell their houses. Institutional investors really can't then pile into real estate because there's too much risk in it at that point. And so their back office people come back and just go, no.
I will also say on the institutional investor side of going into real estate, especially looking at companies like BlackRock and some of the larger ones, there is a bipartisan desire to slap them out of that after some of the anger that came from COVID and the belief that they were the ones pushing up the prices. And I don't know if they'd be willing to tempt fate during all of this. Pick up more of that.
The big thing I've noticed more generally talking to people in finance is the current sort of big goal is don't draw attention to yourself.
Yes. Whereas
just do your thing quietly and don't have people notice you. Because if you get noticed by buying a neighborhood does, and if you get noticed by the administration in a good way, they're going to talk you up, and that's going to screw you over with half your investors. And if you're noticed by them in a bad way, that's also going to screw you up with half your investors.
So I'm waiting to see if they start purchasing manufacturing heavy industry sites, because it's mostly been biotech, commercial real estate that I've been noticing over the past couple of years.
Is someone who works in oil and gas, if people would like to purchase former oil and gas processing facilities, they are welcome to do so.
That is funny. That's funny.
I wasn't looking to get a EPA Superfund site, but you know what? It's convincing.
It's not a Superfund site until you test it.
Don't look under the rock, and there's nothing under the rock.
Yeah.
Well, and so looking at like institutional versus retail investors, and retail investors broadly, regardless of wealth status, I would say that as like an institutional investor, yeah, you need to make returns to your own investors, and like you're not going to be incentivized to buy up real estate if people can't afford to pay rent, and you're not just going to buy real estate to store value in it with the hopes of it eventually going up and reselling it and all that. I mean, you could do that, but
right. Well, you want your 2% under management and your 20% of upside. And if you're not going to make the upside, fuck it, do something else.
Yeah, but versus like retail investors, and I guess this gets more towards like middle class investors. There's always been this idea, as flawed in some ways as it may be, that it's like, oh well, you'll buy a house and it'll appreciate over time, and it'll be a good investment for you, and if you live in it for the life of your mortgage and sell it eventually, you'll come out ahead. And it's like, cool, that's great, that's fine, but like, again, if you're in a bad economic spot, like people are losing homes or losing jobs, and the impacts that has, then that's gonna, it's like, who's gonna go out and buy a house for the sake of buying a house themselves? And again, like institutional investors not just gonna go buy up
to
homes and sit on them in hopes that, well, the economy will eventually recover and people will want to buy homes then. So I'll
I
just
mean,
spend my capital and sit on it and sit on these homes
right, well, your
until
thesis always, on the institutional side, your thesis always includes a timeline. And
Yeah.
these are the kinds of circumstances where you couldn't write that part of it. So when they're looking at it on the risk side, that timeline is a big part of how we look at that. If someone can't answer that, there's like, well, then your risk is unlimited because it could be 100 years. I mean, one thing I think that's underappreciated with something like, say, rent real estate is that when it becomes volatile for some reason, it becomes incredibly volatile. The example I use is so, and someone's going to like OSINT this into finding my old address, but the condo I used to live in Las Vegas originally sold for $1.1 million. Then 3 years later, it sold for $60,000. And then it sold for $200,000. And then long after I moved out of it, it sold for $500,000 and then $100,000. So it's not, when real estate gets distressed, it moves a ton more than almost any other asset class.
Is that a Vegas thing? Because I've never seen real estate move like that here in Virginia. Outside of
So
like
that
something
what?
that has clearly been damaged.
that
what-
tends to be, so. Sorry, say again.
Oh, sorry, I was looking at the thread. I think I missed something. Go ahead.
So Las Vegas tends to be more volatile than most because how much the economy here is driven by people's like discretionary spending. You see real estate in places like Las Vegas and South Florida and Southern California are the ones that tend to move that way, where when it's in demand, it's super in demand, and when it's not, it's not.
Interesting.
Someone brought up a good point. No, it's the sage again, but the thing I posted was a graph of occupied units, vacant units, renting units. And you can see we're really suffering in the housing supply side of things. Supply costs and tariffs are not going to help that. And
Now,
I just saw a headline that did say that Trump's trying to open up things for lumber production, but that's not all you need to build a house. So
right, well,
we're going to
also,
have
yeah, I
issues
mean,
either
you
way.
have the tariffs which impact the things you make a house out of. Then you have the people who are going to build the house who are now, I don't know, sewing stuffed rabbit heads on stuffed rabbit bodies. I actually
Right, because
agree
we're
with
still talking
Tony,
about the
by the
trade.
way, that to me it's insane that we view like where people will live as a thing they invest on. That's
Agreed.
always just baffling to me because
But
you're normally so like I'm gonna go through this really fast because it's not really what we're talking about, but it's always fascinated me. Normally, when you invest, you try to come up with diverse investments that don't correlate real well to each other. When you purchase a house where you work, you make yourself incredibly exposed to your local economy. So, for example, if you buy your house here in Las Vegas, when gaming's doing well, your employer's paying you way more, your house is worth way more, everything's great. When gaming sucks, you just lost your job, you're totally underwater on your mortgage, and you and all your friends are totally broke. So it is baffling to me that that's viewed as an investment.
This is why I have a bunch of farmland.
Can you grow red beans on that farmland, Moto?
Yeah, I should have seen that coming.
Red beans and chickpeas.
I still owe red bean hummus. For people that aren't tracking, a long time ago, I thought red bean hummus would be a good idea, and I just haven't had time to get to an Asian grocery in about a year and a half to make said red bean and hummus recipe that I cooked up in my head. So if anyone wants to make it for me and let me know how it is, much appreciated.
Now, you don't get out of it that way. Let's see it's interesting to me, clear on the chart you posted, how you see people, leaning further into renting and things like that. And so like using the house I live in now as an example, because I know it, my rent is way below what it would cost me to buy this house. So my rent is, I don't know, my rent's about $2,000 a month. And then if I were to buy this house and get, a normal mortgage on it, my payment would be something like $3,500 a month. So we are in a really weird spot for particularly small scale landlords, just because interest rates have done what they've done.
Sorry, I had my dog start barking, but what's interesting is we do still have a correlation. Like we were in a bad spot after 2008 where renters were just skyrocketing past where the owners were. We're kind of bringing that back into parallel, but that vacant number, I was looking at it and it's at like 2000 and what year is that? 2003 levels, and
Which
that
vacancy number?
is, if you look at
Vacant housing units.
yeah, vacant housing numbers. So it's housing inventory estimate of vacant housing units in the United States. So it goes all the way back to 2001 when they started tracking it. And you can see it, goes up, 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 and it halts at its peak, which was 2008. And then it, we start burning it off and kind of stabilizing things, but it never comes back. So we end up back where we were in 2001, or 2003, which might be fine, but, it should go up with population relative to where it was before the
Right, should be
spike.
the same ratios and all that. So one question someone brought up is how the tariffs work with the transportation industry in particular. I don't think so. The industry I'm the most familiar with is energy, which is oil and gas exploration, basically. But we do. They all sort of turn into the same thing with moving products from where people, where you make them to where people want them. One of the things that in the tariff package, if you look at it, there are some products that are exempted from tariffs. One of those is oil and gas. And the reason for that is producing a ton of oil in West Texas does not get you gasoline in Vermont. And so a lot of the existing supply chains now that are balanced by essentially by international trade, because you're making something somewhere else. If you make something on the West Coast, it may be cheaper for someone on the East Coast to buy it from Europe. When you do the tariffs, you lose that. And so now you have this whole set of products that instead of going by ships, which are far and away the most efficient way to move things, you're moving them by trucks and trains and those kinds of things. And so I would expect over the near to intermediate term, you're going to see a lot of demand on transportation to sort of patch over these planning, these sort of logistical hiccups that companies will run into. For the U.S. making enough oil, the U.S. is a net oil exporter. So if you took all the oil the U.S. consumes and all the oil it produces, there's a surplus. The problem is it's not really in all the places that we want to use oil. So there's a huge surplus in places like West Texas and North Dakota, while there's a big deficit in places like the Northeast. And so that's generally handled by U.S. crude oil is shipped out from the Gulf of Mexico to Europe or Asia, and then in the Northeast, they import it.
Do you think that's one of those things
and-
actually that would solve itself? The Jones Act got relaxed.
Realistically, what would solve it is pipe. That's
Fair
far
enough.
and away the most economic way to do it. If the Jones Act was relaxed, shipping to Western Europe versus shipping it to the West Coast by ship, they're pretty close together. So what you would probably see is West Coast pricing would be more in line with crude oil pricing in Europe. And for Iran, there are some particular sectors that are excluded. Like I said, energy is one of them. I'm not familiar with the others. I didn't go through that set of list. I just was told it's excluded.
I have not had time to look at the full list yet either. So that's been one of the more interesting things. Glad to hear that energy was excluded. But I wonder if batteries have been excluded. That's one of the things I need to figure out. Because I don't know if y'all realize this, but most of our batteries are not made in the US unless they are lead acid batteries.
That is
anyone
why
that
one
tells
of the
you-
drones I have can fly on lead acid.
God. And if anyone tells you lithium batteries are made in the US, go laugh at them, please.
I will say one of the things about the whole tariff thing that introduces some maybe uncertainty on one hand, possible hope on another, is, and this goes back into like the regulatory side of the world, is that the tariffs, the so-called reciprocal tariffs, are promulgated under IEPA, the International Emergency Economic Powers Act, which is usually what we use to sanction other countries. There hasn't really been, I mean, not hasn't really been, there hasn't been any use of IEPA for tariffs, and especially not this wild. The closest thing is that in 71, Nixon brought out a 10% tariff on all imports, and that was under the Trading with the Enemy Act, TWIA, which was later reformed into IEPA. But there's a lot of legal debate over whether IEPA gives the president the authority to issue tariffs. Lawfare
And the
came out
House
with a
has
good
had to
article.
do some. The House has had to do some sort of legislative gymnastics to make it work, hasn't they?
Yeah, because because the national emergency part of it, because the actual executive order talks about IEPA. IEPA is the first thing that it mentions for authority. National Emergencies Act is the second, and then there's a couple of like tariff specific things, but they don't necessarily give the president those sections don't necessarily give the president the authority to add on new tariffs. It's just more or less how some of that gets worked into HTS. I believe IEPA is the
Well,
big
and that's
thing, but the National Emergency Act basically says that Congress has to review this within a certain amount of time after the emergency is declared. I want to say it's 15 calendar days.
yeah, that was. I think
And
the House had their thing where they just declared that. Well, it's one
the
day.
rest of the year. Yeah, the rest of the year is one calendar day. Which so Congress isn't necessarily going to review this because the speaker doesn't want to put it on the yeas and nays of who's going to,
Right.
who in the GOP
I
is
mean,
going to
in a
support the
sense,
tariff.
So-
in a sense, by doing that, they have reviewed it.
Well,
In a sense, I guess, although it really sidesteps, and it's been used to sidestep national emergency declarations before. The Democrats did it back in like 2020 or 2021. A couple Republican congressmen wanted to vote to end the COVID emergency, and
Mhm.
and to sidestep that, the Democrats did this similar workaround that it's like we're declaring the rest of the year to be a single calendar day. Um, but I'm surprised we haven't seen as many challenges yet to the tariff declarations. I think that Canada and Mexico weren't really being challenged much because of some of the uncertainty there, and that it was being delayed and all. We might see challenges soon to the reciprocal tariffs. Lawfare came out with a pretty decent article back at the end of January about like the case against IEEPA tariffs. Um, and I personally find it pretty compelling. Um, and the only issue is that it is that there was a court decision in the 70s um, following Nixon's tariff declaration because this was under TWIA, but there was a similar case. So there was a case at that time trying to challenge Nixon's 10% tariff, and the uh, appeals court ruled in favor of the TWIA tariffs. The IEPA language isn't that different, but nevertheless, it's I think it's an uphill battle to legally justify IEPA tariffs. But that again introduces uncertainty, and I'm sure somebody will challenge the tariffs.
I
Who
think,
knows
that
what
goes
kind of
to,
actor they'll be, but for businesses, it's
that
like,
does
yeah,
go into,
tariffs.
do you want to be the business that says that?
Exactly. One, do you want to be the business that says that? Do you want that attention put on you? But also, um, it as much of I see it being an uphill battle to defend IEPA tariffs. From a business aspect, yeah, your tariffs are going to impact your bottom line. You don't like it. Is it better that you shut up and take it and learn how to deal with it? Or uh, are you going to try and fight it and then have the possibility of it being struck down? Okay, cool, I don't have tariffs anymore. And but then all of a sudden it goes to an appeals court, and the appeals court says, okay, tariffs are back on, or no, they're off. And then maybe it goes to the Supreme Court. And so this just gets drawn out over such a long time that you could have injunctions and restraining orders and all of this that are pausing tariffs and putting them back on, and you just don't you might not want to deal with that as a business, and you might just be willing to say, this sucks, but I'm going to deal with it.
there's a couple of things here that are going on that I just want to bring out. Constitutionally, the legislative branch has almost complete authority to create tariffs. They have delegated most of that to the executive branch. And so, better for worse, whether y'all might have some opinions on this, Speaker Johnson had the Congressional Budget Office, I think, or one of the other analysis groups within the House do a report in early February. They published it late February that explicitly outlines the current regime of tariffs that have been delegated to the executive branch. And it is broadly accepted that the executive branch in the current environment, in the current legislative landscape, can just go ahead and create whatever tariffs they want. And that will be fine.
enough of. I mean, it's sort of like the
Until the
authorization for the use of military force.
Yeah, until the legislative branch wants to start clawing some of that back. And we saw that recently with the Senate. So the Senate said, no, we are going to start clawing some of this back. And enough Republicans jumped to join the Democrats to possibly put a stop to the tariffs on Canada. And now they're going to have to take that up for a vote, I think, in the next couple of days, if that hasn't already happened. But we
I think
are
the
an
other
environment
question
where
there is,
the legislative branch could act against this if the desire to do
feel
so.
pressured to do so.
Yeah. And
I
then
mean, one of
to
the
your other
problems
comment,
I see though is
Apogee, just really quick. From a business perspective, no individual business would be suicidal enough to take this on. You would likely see it come through an industry group.
well, and
Yeah.
one of the things that I think a lot of this also leads into is if the idea of limiting trade in this way through tariffs doesn't work legally, my expectation would be that the administration simply uses other methods to get to the same place. There are a lot of ways to be protectionist. And
There are, but there won't be many other ways they can use to generate revenue the way they want to.
right, well, and they lose that sort of budget item that allows other things to happen. See, we've been going for a while. I'm happy to keep talking if you guys want to, but we can also wrap it up.
I said earlier I could go for days. We can make Cory Booker look like an amateur.
We'll just run
Because-
Florida out of hard drive space. That's the plan.
Yeah. Look, I mean, as long as people have questions or something like happy
Yeah, I mean,
about it.
yeah, it is interesting. Sage mentioned that it's nice to know that, okay, like people who know about some of the finance stuff are also just utterly baffled by it. And that's, yeah, everyone is confused. So for the housing market to crash, the housing market now is nowhere near as leveraged as it was in 2008, and a lot more of that debt is backed by the federal government. And so that means if you are a mortgage lender on the risk side of things that made you close everyone out in 2008, now you're able to just say, okay, well, the feds are going to bail this out because they've legislatively said they will, so I can just foreclose. So you don't have the same risk environment you had then for those companies.
And
They can't be compelled to liquidate. You can carry your mortgages at 1-to-1 on your balance sheet, no matter what the value of the house does, because the U.S. government is backing that mortgage.
and one thing to say about like mortgage delinquency rates, because there was something that went viral a few days ago, I feel like, that was talking about mortgage delinquency rates being up, and there was some graph that was used, but it was kind of like misconstruing the graph as representing delinquency rates. This is from the Fred. Now it's accurate as of February. That's when they last updated it, and there was there was a increase in Q4 of last year, but it's not a
It's not
not a terrible like increase or anything.
I mean, and the thing
Just relatively speaking.
thing I know looking at that graph too is that with the exception of 2008,
Yeah.
Other recessionary environments didn't. I mean, you can find, you can see the 2001 crash in there, you can see COVID, but they don't seem to have excuse me, they don't seem to have a huge impact on, delinquency. That seems like something that is generally going to be very sector specific. So for
And like,
the
and
next
it looks like
question
it's
about, okay,
oh, I was gonna say, yeah, so like it's just generally hovering around like 2.5% or lower most of the time, with the exception of like 2008 and then the recovery from that. I mean, and we do see that for a pretty lengthy time. I mean, it shoots up there in 2007, 2008, um, and eventually peaking around that looks like 11% ish. Yeah, 11.5% in Q1 of 2010. And like, and so it stayed relatively high. Like, we didn't get below 2.5% until Q4 2019.
well, and in that
And like,
environment,
and even with
you had all the mortgages where the mortgage was for so much more than the value of the house,
yeah,
that there was sort of no reason to pay it. I knew people then who just basically their response to their bank was like, okay, fine, foreclose, eat 90% of this,
yeah.
or you
I
can
mean,
wait.
and
Hey,
so like,
Carrie,
so even with COVID, like we're at like it. If you look at just how things were trending, it's like we're kind of at where it should have been. Like if COVID didn't happen, if
Right.
and so I don't think that, like, I'm not personally concerned about uh mortgage delinquencies right now, um absent something
And they're
truly
not,
catastrophic.
well, and they're not systematic the way they were.
Yeah.
All of that being federally insured means that if you're a bank or, an institutional investor, no matter what happens to mortgage delinquency, you can carry it basically at 100% on your balance sheet. For all intents and purposes, it's exempted from being marked to market in most cases. So on the question about sort of protective actions you can take, so one of the things we talked about early is how this crash so far is unique in that assets don't, everything is down. So normally what people talk about when it's okay, I want a less risky portfolio or I want less risky investments is, you talk about things like treasury bills and gold and, stuff that tends to retain value even when economic conditions are bad. What's unique about this is those assets are also going down. And so I'll go ahead and send that again. So what we would look for if we were trying to mitigate this risk as a, institutional investor or hedge fund is similar to what you do if you're, an individual. But what we would look for would be, which things in this set of data aren't correlating with each other. And that would tell us, okay, here are different things that can hedge our risks. So here, we have the S&P 500, natural gas, oil, gold, and silver. Normally, silver sort of sits in the middle because it's used industrially. Gold tends to go up in distress because people view it as kind of a safe place to go to. Whereas natural gas and crude oil tend to be, indicators of economic activity. They're all kind of going with each other. And so that makes trying to come up with a good way to protect your assets really difficult. I know Ryan earlier posted the link to, I think it was the Treasury's inflation protected bonds. Those are probably some of the only things that are somewhat protective for this. So far, those aren't, inflation protected assets haven't been outperforming non-inflation protected assets in this environment, which is a little weird. And it just kind of goes back to that everyone's kind of selling everything. The upside is you can't really do that indefinitely. At some point, that pile of cash has to go somewhere. And that's what we will probably see on Monday is where that allocation is.
I do want to back up for a second. Akiri, whatever, the fish with the fun glasses, profile pictures. I believe it wasn't delinquency rates on mortgages that were going up, but I do believe delinquency rates on revolving lines of credit are starting to tick up and have been for a while.
Right now, and those really, that tends to be a combination of sort of broad economic activity and the interest rate environment. One of the things that the Fed has said in the past is that they don't exist to bail out government policy. And so I think if we see massive inflation or something like that from this, we'll see them, we're not going to see them hold interest rates down to try and preserve economic activity. I think what we'll see is them push rates up to try and control inflation.
Well, that list looks like it's been ticking down recently, or at least through 2024 to now. Wonder what it's done the past couple of days.
And again, I'll note that if you look at other crashes, 2001, and then 2012 to 2014, you don't see a strong correlation generally, because what happens is banks stop loaning people money. So even though consumers have less cash and don't pay, banks make it harder and harder to get credit, and so that tends to help pull those delinquency rates down.
And I think like looking at even different types of lending, like we're seeing like some of this is an uptick in delinquencies. I mean, yeah, like you look at credit cards, you look at consumer loans, it looks to be up quite a bit. And in particularly a very short amount of time, and I think some of that's due to inflation. But I still have a hard time reading that all of a sudden means we're going to have some sort of like market crashes or anything along those lines.
Well, and these tend to be fairly trailing indicators. On the business side of things in particular, your bonds going into default or being delinquent is kind of the end. When you hit that, that's when the company is insolvent and being liquidated. So they do tend to also be pretty trailing indicators. So I don't think things like delinquency would even reflect much of anything after Trump was elected. That event wasn't predictable enough for someone to trade around it or to make decisions around it. So I think, it's probably, if I had to guess, another 6 months to a year before we see really material changes in that, unless, the tariffs just absolutely wreck things and people just go, screw it, I'm not paying my credit card.
Yeah, and looking at like business, like the delinquency rate for business loans and for commercial real estate loans, like they're starting to tick upwards a little bit more. Again, but we're still talking like close to historical lows. That pre-COVID, for commercial real estate was, it looks like an all-time low. And or sorry, no, actually Q3 2022 was the all-time low. for commercial real estate delinquency. Like, but almost right before that was Q4 2019. And now we're starting to trend up a little bit more. We're at like 1.57% delinquency rates right now, but it's
Right, which,
generally
I mean,
overall stable. Like,
which, this people a lot of times will talk about interest rates and, what makes sense with that sort of thing. If you go sort of like the efficient market version of this, the natural interest rate should be roughly whatever the delinquency rate is. And so it is, whenever you see that graph, it's always kind of interesting because that lines up pretty well if you view delinquency as a trailing indicator.
I guess that makes sense. Yeah.
Yeah, because theoretically speaking, if 1% of borrowers default, your bank needs to charge 1.1% on its loan to make money. And if it goes above the cost of capital to do that, then some other bank will come in and loan the money a little bit and accept making a little bit less money. So those tend to stay really close to each other. But again, the current environment is one where a lot of these sort of things that are just taken as like fundamental economic truths haven't really been thought about or studied in the context of using things like tariffs this way. If we do this for too much longer, the futures market will open, and then we get to talk about that.
I was going to say that we're starting to see markets open in the Middle East, and they're coming down fast.
I've got.
I think someone was just posted about Saudi Arabia has crashed about 7% so far today. They've been open for an hour or two, I think.
Now there's a little interesting because Saudi Arabia, Dubai, markets like that tend to be very energy dependent for obvious reasons. And so, they tend to track very, very closely with what crude oil does. I think oil and gas may be one of the sectors that other countries realize they actually have a stick to hit the US with, just because the US is the largest exporter of petroleum products. So there's some of the movement there will also just be related to the price of oil and reduced economic activity too.
Also, I apologize for my earlier statement. Saudi Arabian market was open today. Sunday is a business day over there, and it is now closed. So it fell about 7% for the day.
Okay. Now they wouldn't have been open Friday, so that would be their.
Correct. I made the classic I forgot about business days in the Middle East mistake. I don't know, Ari. My egg prices still haven't come down too much, but I own my own chickens, so I have set costs there.
Until you have to pay for grain.
It was an acre of land for 6 chickens. They can eat well. Yes, it is
I will
true that
just.
these tariffs are worse than the Smoot Hawley Act Sage by I think almost an order of magnitude.
And I will just note that egg prices in Las Vegas are still not bad. But they didn't get bad to begin with, so I'm not sure I'd notice.
I didn't really notice them until I was out of eggs the other day and had to go to an organic market and pay $11 for a dozen organic eggs. But those are organic.
What a moment for the city you live in. That is classic.
I grew up in Northwest Arkansas, so I was used to eggs being like less than $1. I do question how many eggs people consume, though.
A dangerous thing to question on this server. We have a couple of individuals who are proud of their 30 to 40 eggs a
Yeah.
day. Do y'all have any other questions? I see a bunch of people typing. Are those questions or those
We can talk about eggs too. I'm good.
further shit
I
posts?
warned people that this would turn into the standard EMVC thing. So
I'm down. The real question is chicken egg markets have been rising. What about like duck eggs or ostrich eggs? We've seen any movement in those markets as people have looked for alternative egg products.
unfortunately, I cannot pull up a futures market on duck or ostrich eggs.
Really? I'd be surprised if there wasn't one over in the EU somewhere or Asia for those, at least for duck eggs.
So one of the things I do, and I know it's kind of running into the chat in our conversation, is people, you have a lot of conversations about the tariffs being good and bad. To me, when you look at it like on the investor side, nothing, there's not really a value judgment associated with that. It's more they just are. They introduce a lot of volatility, and it's really obvious that markets don't know how to trade this. Those being good or bad depends on whether you're long or short. It's They're definitely very unorthodox as far as ways to try and manipulate the economy.
Has anyone else done tariffs like this in modern time?
Uh,
I mean, not
a
like this.
developed country.
Has any Western country done tariffs over 10%?
The only thing I can think of that would be, you can come up with some. The problem is when that's happened, it hasn't been, the country wasn't developed at the time. Like this goes back to sort of like that economic thought thing where no one, there's kind of a no one does this. You can look at Japan, like I said, in like the early 70s. A couple of Latin American countries have done similar kinds of things. It quickly evolved into something else. In the case of Japan, led to a big industrial expansion, which was then leveraged into a bunch of other things. In Latin American countries, it tended to just kind of blow up. Like you didn't see it over time because they couldn't sustain it. Now, the US is kind of unique in that it's large enough and there's enough economic activity that you can run a bad decision for a lot longer. So there's not really one that occurs to me where you have